Hi, everyone. Thanks for joining us today. We're going to get started in just a couple minutes to give folks a few more minutes to come online.
Oh, great. I just noticed a name that just came in. That's someone I just invited on the weekend. Perfect.
Okay, well, it's 1:02, so let's get started and we'll allow people to come in as they come online. Hi, everyone. Welcome. My name is Patrick DeRoshi. I'm the Pension Engagement Manager for Shift Action for Pension, Wealth, and Planet Health, or SHIFT for short, we'll call it today. Really happy to be here today, and I want to thank Jim and Brian and Renee from AIMCo Elders for Climate Action and Calgary Climate Hub for having us today. It's great to have you folks welcome a couple of guys from Toronto to talk about Alberta pensions and climate change today. So we really welcome the opportunity, and we hope we have a good discussion. We're going to be presenting for about 45 minutes and want to leave the second half of the webinar, about another 45 minutes for questions, answers, and discussion. But feel free, if you have a burning question, to raise your hand or speak up, and we can try and address questions as we go as well. We're going to be running a couple of polls throughout the presentation as well, where you'll have a chance to do a survey based on multiple choice questions we want to get some feedback from you, as well as learn more about your concerns about your pensions and which pensions you pay into as well. My colleague Adam is going to be the first speaker, and I'll probably come in the second half of the presentation. And this webinar is also being recorded. So if your friends or colleagues have missed it, we'll send it around to the group later on today or maybe later this week. And just a little bit about SHIFT. We are a small NGO that's dedicated to mobilizing the beneficiaries of Canada's largest pension funds to engage those fund managers on the management of climate risk. And we want to see those investments shifted away from risky fossil fuels and into profitable climate solutions that will protect your pensions in the long term. So we do a lot of tracking of Canadian pensions investments in fossil fuels, as well as climate solutions like renewable energy and clean technology. And we also do a lot of communications, education, and advocacy work. And with that quick intro, I'll turn it over to my colleague, Adam, who's going to lead off the presentation.
Hi, everyone. Yeah, thanks for having us. We're really excited to chat. If you hear a little bit of a baby in the background, that's just my 8-month-old, so don't mind that. Yeah, and to introduce myself and Patrick, we're both climate experts. We've both been in the field for some time and have been doing a lot of policy work at various levels, national, international, domestic levels. And we both feel pretty strongly that the finance space is actually one of the largest and untapped areas that needs to be addressed to address the climate crisis. And so that's why we're both really excited to be working with SHIFT to actually mobilize moving billions of dollars of capital into solutions to the climate crisis. So that's really what makes us excited to work on this project. So I'll give you a quick outline of what the presentation is going to look like today. we just did introductions. We're going to quickly do a quick overview of the climate crisis to put this conversation in the proper context. I think that's really important. And we're going to spend a lot of time talking about the financial risks of climate change for your retirement savings. So while this conversation around climate change is largely anchored in an ethical discussion about climate change, it's really important to understand that we're talking about people's real retirement savings here and their pensions, and it's absolutely critical that we're protecting those savings and growing them over time. So that this whole conversation needs to be very clearly anchored in avoiding financial risk and taking advantage of opportunity. Sorry, we're moving everything around here quickly. Right. So, and then we'll talk about the opportunities that this provides. We're going to go do an overview. Patrick will walk us through an overview of the information we have on AIMCo, which is the big Alberta pension plan that covers a lot of different sub-pensions. And then we'll talk about how low carbon pensions are going mainstream, and we'll go through on how to engage your pension fund. That should take about 45 minutes. I'm hoping we should have lots of time for Q&A discussions. If at any point you have a question that's burning or you didn't understand something that we said, because we're going to talk quite a bit in this next section, feel free to post a question in the chat. And if it's really timely, we'll just address it on the spot. And if not, we'll hold it and we'll have a longer discussion about it at the end. All right, so we'll just dive right in, shall we? We'll start with a survey question, because it's really important for us to know who's on the call and where people are coming from in this conversation. So the question here is, my AIMCo pension should, how is your response to this statement? My AIMCo managed pension fund should not be investing my retirement savings in fossil fuels. Do you agree, somewhat agree, neutral, somewhat disagree? Because it's important to sort of see where people are starting out on this conversation. Please click on the link and fill it out. You think it makes sense to go over the results right now, Patrick?
I haven't seen any come in yet. We could break maybe after the first section to go over the results.
Okay, that sounds great. We'll carry on then.
Is everyone seeing the poll come up?
Yep.
Yeah, I'm seeing it on my end. Lots of people are taking the poll.
Great.
So.
Yeah.
So we'll move right on to the content here. So putting this conversation in the proper context, let's talk about the science of the crisis very briefly. And this will be review for a lot of you, but I think it's really important to sort of frame how we're coming at this. So this graph shows very clearly the atmospheric concentration of CO2 since the end of 1950s until a few years ago, and clearly shows the dramatic trend and increase in atmospheric CO2 in the atmosphere. We've seen an increase of more than 60% increase in atmospheric CO2 at a global level in basically one human lifetime, which is unprecedented and quite substantial. And this graph shows the growth in the burning of coal, gas, and oil. Carbon that was previously trapped safely in the ground has been dumped out into the atmosphere, upsetting the balance of carbon in our atmosphere. So this is really the direct cause of that previous graph I just showed you. And you can see why we sort of focused on sort of from 1950 till now. In fact, the bulk of CO2 emissions has actually happened just in the last 25, 30 years, in fact. So this is an accelerating trend. And here is the impact of that change in the atmosphere. This is a measured temperature anomalies, which shows the increase in temperature directly resulting from the change in greenhouse gases in our atmosphere. So there's obviously a very clear scientific consensus around the causes and the solutions to the climate crisis at this point. In fact, the conversation has moved on quite late to be still having not peaked global carbon emissions yet. But I wanted to be very clear at the outset that in addition to land use change and some chemical processes, the overwhelming contribution to the climate crisis has been the result of combustion of coal, gas, and oil specifically. And this is the impact that warming that we're seeing. We're already approaching around a 1 degree average surface warming across the planet, more than double that in Canada. We're seeing dramatic impacts already around the globe. And these are some quick examples of those that have impacted society. So we see that's Hurricane Harvey flooding a couple of years ago, unprecedented flooding in the Houston area. The top right there is Cape Town faced an unprecedented water shortage a few years ago. I was there during the sort of peak of the drought. It's the first sort of major global city to completely run out of water from prolonged multi-year drought. The bottom left there is very relevant for a conversation for Albertans. That's the Columbia Glacier, which feeds the Saskatchewan River Basin, which is the sort of the water tower for the drier parts of the prairies in Canada and for a lot of dry land agriculture as well. And the Columbia Glacier is rapidly melting and is predicted to eventually disappear. And the bottom right there is a snapshot of the Fort McMurray wildfires we saw a couple of summers ago. But obviously every year now we're seeing an enhanced, incredibly dangerous fire season in countries around the world. We had unprecedented fires in Australia at the end of last year. And again, in California this year, it's sort of a continuing cycle every year where we've been seeing these more extreme weather events that have been enhanced by climate. And of course, this is having an economic impact that's measurable as well, that's growing. This is just a graph that shows the insured catastrophic losses in Canada. It's not even that up to date. In fact, this trend continues to the right, where we've seen other incredibly damaging impacts. But these are just privately insured, privately insured losses. And we can see this sort of continuous uptick. Beyond the right side of this graph, you would also expect to see the horrendous flooding we've seen in the Ottawa and St. Lawrence rivers last year, and some of the forest fire impacts and smoke impacts as well on agriculture and for cities as well. So we're sort of seeing continual increase in insured losses related to climate related events. Of course, those impacts are far greater from a public perspective. Those are just private insured losses, but governments are spending. The graph looks very similar for government relief. If you look in the United States, we're now onto our. I think we had the first landfall of a non-named storm. And it looks like there may be another one coming. So they've actually had an unprecedented hurricane season this year, which still isn't over, as another example. So what do we do about all of this? It's really quite a scary challenge we face. We face this global unprecedented crisis caused by largely by the combustion of fossil fuels and our reliance on fossil fuels in our society. And we still haven't even peaked emissions yet. And this graph ultimately shows what the pathways are for stabilizing climate below a threshold that is considered extremely dangerous. So this is you'll often hear about the 1.5 degree threshold. That's the level at which scientists agree that we can avoid the worst and most damaging impacts of climate change and avoid the potential for potentially runaway climatic effects on a global scale. So this graph shows what's required and the drop in emissions that are required to reach that. And what we can see here is if we had started down the path of reducing our emissions in 2000, the trajectory would have been quite gentle and somewhat manageable. But every year we've delayed, this black line shows real emissions on an annual basis. Every year we've delayed, we have made it more difficult for ourselves. The curve gets steeper, and we're rapidly moving towards a brick wall in terms of our ability to actually meet this threshold. And the speed at which we have to actually reduce our emissions right now is unprecedented, incredibly fast and steep drop. If you actually fully understand the science of climate change, you understand that we're not actually seeking to make emissions reductions. That's actually not the goal of climate action. The goal of climate action is to find a pathway that takes us to zero. Zero is the destination. There's no way of getting out of that, because if we're not at zero, then the warming trend will continue to grow and get cumulatively worse over time. So zero is the path. And if we're trying to stay below 1.5 degrees, you'll see the graph shows roughly we need to be halving our emissions within about 15 years from today, and aiming to hit zero by 2050 roughly. And that's going to take some action that I don't think any of us are actually prepared to fully get our heads around the speed at which this is required. So this is sort of a sobering way to sort of kick off the context for the conversation. And I think it's important to sort of quickly step back and take a look at what this means within Canada. These are the emission trends that are relevant for Canada, and I think largely for Alberta in particular. And these are the latest. This is Canada's reporting of our greenhouse gas emissions to the UN, which we do every year. And this is the latest data from 2018. This is a graph produced by the Pembina Institute. And it shows the different, at the top, we see the different sectors of the Canadian economy and emissions trends since 1990 until today, well, until 2018. And we can see that we've actually made some pretty remarkable progress in a couple of areas of our economy, given that the economy has grown substantially since 1990. A number of sectors are fairly flat in terms of emissions, and in particular, electricity there, as we've been phasing out coal, we've made quite substantial progress in terms of reducing emissions. But you'll note that transportation has been going up steadily as the number of cars on the road has increased. But I think most troublingly for Canada is oil and gas is the single largest source of emissions. The production of oil and gas is the largest sector. And it's actually ahead of transportation, which is quite unbelievable. And obviously this has an outside impact for oil producing provinces like Alberta. So just to sort of frame that, we're very aware of the very unique challenges that this produces for a province like Alberta. And we're really sensitive to the fact that it has a much greater impact, this discussion around phasing out fossil fuel production for Alberta than it does anywhere else in the province. And I think we're really, we need to make sure we're focused on making sure there's a transition and that economic activity in Alberta doesn't disappear. And we're taking care of the workers and the communities that are impacted by this very rapid transition that needs to happen. So there's a lot of work that's going into that conversation, and we can talk more about that. So now I'm going to move through as quickly as I can the ways in which climate change creates financial risks. And I think this is really critical, as I sort of mentioned off the top. The ethical concerns are very real here, and I think that's sort of inherent in what I just showed you. But from the perspective of a pension fund or somebody managing their own private investments, it's absolutely critical that we see low risks and high returns for investments. And pension funds have a fiduciary duty, a legal responsibility to invest in the long-term best interest of the beneficiaries in their pension funds. And that means that they actually legally have to pay attention to the financial side of it. They can't sacrifice financial returns for environmental concerns, or they claim that's the case. But what I'm going to show you here is that the opposite is true here. Their fiduciary duty actually requires them to pay very close attention to climate risk, because if they don't, then they're violating that duty. So the sort of four rough buckets of risk I'm going to go through as quickly as I can. I've got a lot of slides here. I'll try to be fast about it. Really clearly indicates that there are very, very substantial risks, financial risks to be had in each of these different categories. So we'll go quickly through them. The first category of financial risk is physical risk, which I think is quite obvious to most folks. As we see increased impacts from fires, floods, heat waves, droughts, sea level rise, extreme weather, we're seeing physical damage to systems and infrastructure that underpin the economy, to physical investments. Pension funds in particular have large real estate holdings, and they own a lot of real assets out in the world that can be impacted directly by climate risk. And I think that's sort of straight ahead, so I'll keep moving forward. The second category of climate risk can be found in this transition that we need to see from a fossil fuel dependent energy system to one that is based on clean energy. It's driven in part by policy that pushes this forward, but mostly through the actual disruptive impact of technology. And we've gone through a number of the sort of technology disruptions in the past, and we have some sense of what these risks actually look like. And a good example I always draw on here is if you were an investor in Blockbuster Video in the sort of mid 2000s, you might not have seen the rapid disruptive influence of Netflix arriving on the scene and shifting entertainment over to streaming digital. But Blockbuster Video went from being a huge and very profitable company with stores all over North America to going bankrupt within just a few years of Netflix taking over. You can see the similar example of the horse and buggy transitioning over to cars at the turn of the century in North America, at least. This transition took only about 10 to 12 years, depending on where you were, from the majority of people using horses to get around to the majority of people owning a car and getting around. And it's the impact of that has been widespread on a number of different sectors. But maybe one of the better examples is in the transition from film to digital cameras. Kodak actually owned the intellectual property for digital cameras and was an early producer of digital cameras, but they still had a strong vested interest in selling film, and they didn't push all the way through and weren't positioned to be successful in that market. And so when smartphones came around, Kodak as an entity financially just wasn't able to participate in the disruption. And that's an example of a rapid repricing of a company's value as a result of a technological transition. And we're seeing a lot of those as we move through the clean energy revolution. And this is sort of why. This graph shows the decline in cost for installed solar photovoltaics, which are now the cheapest possible new installed electricity generation possible, second only to wind power, which is cheaper than solar. And they're heavily competing right now for which is the cheaper option. And they used to be, everybody still considers them expensive, but they're unbelievably cheap now to install. This is the similar looking graph for lithium ion batteries, which is now even further below. Estimates are now that it's below the $100 mark here on this graph. And that's going to very quickly lead to electric vehicles becoming cheaper than internal combustion engines. They're already cheaper to own and operate. And that's having a disruptive industry impact on the auto industry, but also the oil industry. And it will increase over the next 10 years dramatically. And this graph sort of shows the drop of a number of other technologies as well. From 2010 to 2018, the drop in cost for solar PV, offshore wind, onshore wind, bioenergy, geothermal, and hydro. There's been a substantial drop in all of these areas. So disruptive technologies are here. And it's a good thing because they're helping us to rapidly turn the page and decarbonize our economy, but it has very real risks for people who are not paying attention to what this will do to all of the legacy industries that exist. And here's an example of, we've already seen some of these technologies having an impact, and the transition in the energy sector is already having a financial impact on the major players. And companies like Exxon here have actually trailed as a result of their inability to adapt to this new situation. So we're seeing fossil fuel companies already underperforming financially across the economy. So we can see, yeah, these risks are already apparent. Yeah, and we've, I think we've seen, we saw a very substantial underperforming of fossil fuel companies across the board leading up to the COVID-19 crisis. They were already seeing very poor returns over the last decade in every case. And now that we've got this crisis, we've seen what happens when there's an accelerated drop in demand for fossil fuels, which is what COVID has sort of shown us in a very short period of time can occur. And so we're seeing the market value of fossil fuels globally drop dramatically, as high as 50%, 60% in some cases, waves of bankruptcies of smaller players. And it's been quite a dramatic ride in the last few months. This is Royal Dutch Shell writing down substantial number of assets because they don't expect oil and gas demand to ever rebound potentially. There's quite a few analysts and experts, including the oil companies themselves, who think that global oil demand may have already peaked. And the COVID-19 crisis will have brought that inevitable peak forward. And if it doesn't peak, it's going to be flat and then it will peak. So we're not expecting to see oil demand increase long-term ever. I'll move on from the transition risks. I think that's sort of well covered there. We can talk more about it later. Into the policy and regulatory risks. Obviously, we haven't turned the corner in terms of dropping global emissions. So governments have to dramatically pull the levers they have at their disposal to get emissions down. And that means a lot of new policies will come online in the next while. Carbon prices need to go up. Internal combustion bans, we're seeing that in California, and BC's already announced them. I think we're going to see phase out timelines for internal combustion engines in most major economies in the next while. Major building retrofits will reduce gas demand across the board, phasing out coal, reducing industrial emissions, and generally electrifying whole parts of our economies that were dependent on fossil fuels. And finally here, this is the legal and reputational risk. Fossil fuel companies are very much at risk from litigation and legal challenges as a result of their very intentional efforts to block climate action over the last several decades. And we're seeing a growing number of these cases where fossil fuel companies are being sued much in the way that tobacco companies were sued in the 1990s for obscuring the realities around cancer and smoking. And finally, the sort of largest area of risk, I think, that's not well understood across markets, and it's something to really think about carefully here, is that there's a cost of inaction. There's a risk that we actually don't succeed in addressing the climate crisis, and that's the worst possible outcome for your retirement portfolio, for your pension fund or your private investments. And that's because failing to address the climate crisis will lead to a cascading series of failures and GDP impacts around the world. So you could sort of get a small taste of that from the Australian wildfires last year. It had this devastating impact on a number of different industries, on the health of people, particularly the Australian tourism industry, but a number of other areas, and it actually depressed Australia's GDP growth. But we're seeing, water shortages, extreme weather. We're seeing potentially migration from areas that are facing these environmental stresses, putting stresses on other countries. We're looking at a series of interconnected systems that will be impacted by runaway climate change. So we don't really want to think about this as too deeply, because it's quite disturbing to think about what happens if we don't address the climate crisis. But if we don't, it's important to understand that the impacts are far worse than anything else I mentioned. So this is something we have to think about. We're very worried that if you're a young pension beneficiary, if you just started paying into your pension now, in 30 years, you may have a very difficult time getting the full value of your pension if your pension fund isn't part of the solution to the climate crisis. And there's a couple of slides here that just sort of talk about all of the already observed headwinds to GDP growth as a result of climate impacts. So that's all doom and gloom, but it need not be. There's a huge financial opportunity here as well that coincides with that disruption we talked about. So the massive exponential growth that drives compound interest, which grows pensions and retirement savings over time in the future, will come from technology. It will come from clean energy. And there is a huge opportunity as we make a rapid and unprecedented energy transition across the globe to be exposed to those sectors in your portfolio. And I probably don't need to go through too many specific examples, but we're talking about a multi-trillion-dollar growth opportunity in the market. And so what we're really concerned about is that pension funds and private investments are overexposed to those other climate risks we talked about, and severely underexposed to the profitable, high growth solutions to the climate crisis that we need to see dramatically more capital moved into. And here's a little bit of what this slide actually shows quickly, just sort of already these opportunities are slipping by for investors that aren't paying attention. So these are the 10 sort of major electrical utilities in Europe, and the 5 cleanest power utilities, those that have actually invested heavily in clean energy and have actually wound down their thermal generation, are far outperforming those that have doubled down and stuck with their old system. So if you're an investor, you really need to actually be seeking out companies that are actively investing in the transition in order to make profit. This is sort of 2014 to 2019. You can see the 5 best compared to the 5 worst in terms of financial performance. Investors are paying attention to this now. This is something that's finally taking off on a global scale. It's been too slow. The financial sector is way behind, but we are starting to see concern around climate change start to actually influence investment decisions from major institutional investors. And this is a letter that was published last January from Larry Fink, the CEO of BlackRock, the world's largest money manager and institutional investor. They manage pension funds and money for investors all over the world. And he said, you know, climate change is the issue that my clients are constantly raising with us, overwhelmingly. And we're now going to, you know, rethink our whole business model around understanding climate change. And so this is actually having a very real impact. Just this week, the Premier of Alberta, Jason Kenney, admitted that this was the case. He was saying that the oil companies in Alberta are actually not able to access low-cost finance at the moment because of the perception, at least, he said, of their environmental performance. So investors have looked at those companies and said, we think that there's too much financial risk, and we're not willing to provide low-cost, high-quality investment in capital to you. So he actually came around and admitted that climate action was going to be necessary in order to ensure that capital will continue to flow into that sector. So this is sort of existential, even when you have, you know, Jason Kenney acknowledging that capital flows are actually being influenced by climate. And this is just another graph, just if you needed more evidence to show the energy sector of the S&P 500 from 2010 to 2020 dramatically underperformed the rest of the benchmark. So you can see how information technology at the top there grew 335%, but the S&P energy index was 6% growth over a decade. So you know, for all those arguments over the years, arguing somebody should have divested, and the company or the endowment was saying, well, we don't want to leave money on the table, and we think this is inappropriate because we have a financial responsibility. It's clear that they would have made far more money had they divested any time in the last 10 years. And we now have the data to show that and to back it up. Yeah, so I think that's sort of the covered out all the sort of financial risks of climate change and try to make some of those clear arguments around action on climate change is both the right way to minimize risk for your investments, but also the way to maximize growth. And I think we want to sort of change gears here now and talk about the Canadian pensions and sort of how they're faring, and to get a bit of a better sense of what our view is of how they're operating right now. And then we'll get into what you yourself can do to make them shift their capital faster. So this is a quick overview of the sort of the Canadian pension model. And the Canadian pensions are globally very large and very significant and widely respected. The Canadian model is one where essentially the beneficiaries will hand over their money to private and professional money managers. So we actually have, most of these funds actually have active sort of Bay Street shops that actually independently actively manage the fund and using very sophisticated tools, offices around the world, and sort of the highest quality and caliber of financial professionals in the sector. Ontario Teachers Pension Plan in particular is widely considered sort of one of the sort of top places to work in the finance industry. And so that model is well respected because this active management allows these companies to buy private assets. They're not just investing in the ordinary public stock market that all of us are invested in. They buy whole companies, and they can participate in all sorts of sophisticated private opportunities. But it's interesting because they performed well. I think they have got a real blind spot for some of the issues that we've raised here. So it's important to realize that these pension funds are actually investing your money. You've been paying your salary to these into these funds, and these funds are being privately managed. These pension funds work directly for you, and you have a voice, and you can ask questions about how they operate. It's really important to realize that your engagement with the funds can actually shape the way that they operate. I'm going to pass it over to Patrick to sort of give us more of an overview of AIMCo in particular, and a number of the other sort of pension strategies we're talking about.
Yeah, thanks, Adam. And unfortunately, I don't see the results for that first poll question I asked. I'm not sure why.
I might be able to see them. So let me just see if I can find it, Patrick.
Yeah, if you can find it, that'd be great, Adam. And in the meantime, I'll launch the second survey question as I get into talking about AIMCo. So now we just want to find out if you are part of a managed pension fund in Alberta, and if so, which one you belong to. And we'll talk about AIMCo for a bit here. Just the basics, the Alberta Investment Management Corporation, it's a crown corporation that manages the investments of 31 pension, endowment, and government funds in Alberta. That includes 9 different public pension funds, as well as the Alberta Heritage Savings Trust Fund. It's the 6th largest investment fund in Canada, about $119 billion. So if you think of that, that's the GDP of a mid-sized country. 368,000 public sector employees and pensioners pay into it or are beneficiaries of it. And like Adam said before, these pension funds in Canada are giant, massive financial players. They own large parts of the real economy. So stuff like downtown real estate, toll highways, pipelines, water and electrical utilities, ports. They actually have real influence to shape the modern economy. If Adam can move to a couple slides more, we just have a listing of the funds that AIMCo oversees. You can see in the second column all of the different pension plans, as well as the Alberta Heritage Savings Trust in the first column there. And then there's a number of other assorted government funds that AIMCo oversees. The biggest fund would be the local authorities pension plans under AIMCo, and then another big one that will be coming under AIMCo's control because of the moves of the provincial government in Alberta is the Alberta Teachers Retirement Federations, the Alberta Teachers Retirement Funds, which through Bill 22, and we'll talk about Bill 22 more, is being moved under the management of AIMCo. They've had a decent run over the years, not as good as other Canadian pension funds. But particularly in the last year or so, AIMCo has had some really bad losses. So you might have read earlier this year about $2.1 billion in losses from a risky volatility-based trading strategy that they deployed. And they're also not performing well compared to other funds. So for example, the local authorities pension plan recently said that AIMCo has been short of their growth expectations for 46 consecutive quarters, or nearly 12 years. So we could talk a little bit about why that's happening, but I'm going to get a little bit more into how AIMCo is managing climate risks, the financial climate risks of climate change that Adam mentions. You can see on this next chart here, if you want to change the slides, Adam, we put a report out last year that kind of ranks how these Canadian pension funds are managing these risks. And some of the other funds are much further ahead than AIMCo. We should give AIMCo some credits. They have done some things right on managing that risk. So they're hiring analysts to better collect climate data now. They recognize the risk of climate change to their portfolio. They have in place governance structures to oversee these risks. And they're also increasing investments in climate solutions like renewable energy. But it's not nearly enough. And we also don't have the proper transparency and disclosure to actually figure out if they're doing this properly. You can see on the right side of this graph that we have the Caisse de dépôt et placement du Québec. We kind of put them ahead as a leader in Canada. They're probably the furthest ahead in dealing with this challenge. And they actually have some climate risk measures like setting targets for low carbon investments. So they want 25% of their portfolio invested in low carbon solutions by 2025. They've set targets for reducing the carbon intensity of their portfolio by 25% over the same time frame. And they've also linked the compensation of their executives to emissions reductions so that even the highest performing people in the organization have an incentive to see their portfolio reduce its emissions. Next slide, please, Adam. And like I said, credits where credit is due. AIMCo has put some good governance structures and internal processes in place. They have about $2 billion in renewable energy assets, including 50% ownership of a company called S-Power, which is the largest private owner of operating solar assets in the US. They also have a 90% stake in a company called Eolia Renewables, which is a renewable power producer in Spain. And their real estate portfolio, they own downtown buildings all over the world, has some really high green certifications like LEED and BOMA certified buildings. They have an internal framework on how to manage climate risk, and they're also performing scenario analysis of their portfolio. So they're trying to understand what risks to the portfolio come about from different levels of warming, whether it's 2 degrees or 3 degrees or 4 degrees. And they're also beginning to measure the carbon footprints of their portfolio, particularly their public and private equities, so that they can get a measurement of that and then beginning to work toward lowering it. Next slide, please, Adam. That being said, they have a long way to go. The first thing is transparency and disclosure. You as members don't actually know completely what you're invested in. We've spent a lot of our time digging through every publicly available material we can find, and we still can't actually tell you how much of your pension savings are invested by AIMCo in oil, gas, and coal. We talk about engagement a lot. So these pension funds claim that they need to continue holding these high carbon companies because that way they have influence as shareholders to improve their environmental performance and reduce emissions. But we actually haven't seen any real evidence of any of these companies owned by AIMCo lowering their emissions in line with the Safe Climate and with Canada's and Alberta's climate targets. There's no clear standard or metric for screening out companies who are bad actors. So how long should a pension fund like AIMCo hold on to Exxon stock until they realize that this company is not going to change its business model to align with the Paris Agreement? AIMCo also has no clear timelines and targets for reducing its exposure to these high carbon companies. And they have no targets, metrics, or milestones to align its portfolio with the Paris Agreement, which is what we need to see to avoid a climate catastrophe. Next slide, please, Adam. We'll dig in a little bit here into AIMCo's actual investments in fossil fuels. So the CEO of AIMCo himself, Kevin Ubelin, he has admitted publicly that AIMCo is overexposed to Alberta overall and disproportionately to fossil fuel ventures in particular. He told a Alberta parliamentary committee in 2019 that AIMCo has effectively overweighted Alberta quite substantially, and that they're about 7.5% overweight in Alberta public equities. So they're highly exposed to a relatively small economy compared to the global economy in which they invest. They also acknowledged in their 2018 annual reports that strong returns in 2018 were partly compromised by headwinds faced by the oil and gas sector. So they actually recognize them publicly that their investments are not performing well because of their holdings in fossil fuels. A good example is in December of last year, AIMCo, together with the New York private equity firm, bought a 65% stake in the Coastal GasLink pipeline, which is going to transport gas from fracking fields in BC and Alberta to a proposed terminal for exports on the BC coast. TC Energy actually sold them this pipeline, but it's not yet built. You might remember there was a series of protests and blockades earlier this year in protest of this pipeline. So it faces numerous regulatory, legal, financial, and political challenges. And it's just an example of AIMCo not taking into consideration these risks that they need to consider for their investments in oil, gas, and coal. And I should also note that even if this pipeline is built, there's no guarantee that it will be commercially successful. It's very likely that the gas it exports will become replaced by renewable energy because it's cheaper and easier for places like Asia where they want to export the gas to use renewables instead of gas. Next slide, please, Adam. This is just a bit of a roundup of some of the high-profile companies in AIMCo's portfolio, and we would be here all day if we actually listed off all of the oil and gas and coal that they owns, but here's just a couple of examples. Enbridge, they have about 185 million invested in Enbridge. Canadian Natural Resources, one of the big oil sands players, obviously 162 million. Teck Resources, 87 million. They own an 85% stake in the Northern Courier pipeline in Alberta, which they bought off TC Energy for $1.15 billion in 2019. Pembina Pipeline Corp, $95 million. They also own, along with PSP Investments, the Federal Public Service Pension Plan, Alta Gas, which they bought for $1.7 billion a few years ago. And two of their top 5 infrastructure holdings are Freeport Energy Services and Howard Midstream Energy, which are oil and gas and construction management firms, heavily dependent on the oil sector for their growth. This next slide here is about some smaller junior and mid-sized oil and gas companies that AIMCo's invested in. And this actually goes back to the NDP governments in Alberta. They had something called the Alberta Growth Mandate, where they took money from the Alberta Heritage Trust Fund and invested it in 14 oil and gas companies. You can see them listed here. They favored high-risk small and medium oil and gas producers and oil field services companies. This was supposed to be an economic development package that would help get Albertans to work during the last oil downturn. But unfortunately, it didn't work out. And every single one of these investments has seen their share prices plummet. And that was even before COVID-19 caused the oil crash that we saw today. One of these companies, Trident Exploration, which AIMCo gave $60 million to in a credit facility, has already gone bankrupt. And there's a few others that are on the brink of bankruptcy. The other thing to note about these companies is that they have a combined $3.1 billion in unfunded environmental liabilities. So this might include orphan wells that require reclamation. And we don't know who's going to clean these up. These companies aren't in a financial position to clean up the mess they've left behind. And it looks increasingly likely that it might end up on the hook of taxpayers to pay for these funds. I'll also just note, because these funds did come from the Alberta Heritage Trust Fund, that fund in its most recent annual report this year saw a 5.1% loss. So that nest egg that was supposed to build up investments through oil and gas wealth in Alberta is actually now losing money because of the oil crash. Next slide, please, Adam. I'll go into a little bit of concern we have as well about AIMCo's governance and some growing speculation that it's been politicized. So, for example, there's a lot of evidence of these companies that receive money from AIMCo being political donors to conservative parties in particular, and their board members and executives receiving appointments from the same Alberta government. So a good example is Calfrac, which in 2016 and 17, AIMCo invested about $230 million in Calfrac, which is an oil and gas services company. But since then, their shares have plummeted. They moved significant portions of their drilling capacity to the US. and it's now staving off bankruptcy through a debt-laden recapitalization plan. What's interesting about this is that CalFrec donated $50,000 to a political action committee that was dedicated to electing Premier Jason Kenney in 2018. And its founder and board chair, Ron Matheson, donated $235,000 to the UCP and Jason Kenney's leadership bid between 2016 and 2019. Another example is Western Energy Services. AIMCo gave this company a $215 million loan and bought $11.4 million in shares in 2017. But since then, the company has underperformed. Its stock has plummeted by 625%. And just of note there, CalFrac's Ron Matheson is also a director with Western Energy. So it looks like there was some political pull for these companies to give donations to the governing party and then have AIMCo bail them out with these debt and financing plans. I'll also draw your attention to some political statements made by AIMCo's board chair and executives in recent times. Last May, Kevin Ubelin publicly stated his support to build the Trans Mountain Expansion Pipeline, repeal a ban or a law that bans oil tankers on British Columbia's northern coast, and also to weaken federal environmental assessment laws. AIMCo's new board chair, Mark Wiseman, he also recently opined that they want to see pipelines built and that Canada has no choice but to build new pipelines and that we need to keep producing oil. So regardless of where you stand on the pipeline and oil and gas issue in this country, we think that it shouldn't be the place of a pension manager to be commenting on public policy and politics. And then we also, you probably have noticed this rising issue about the creation of an Alberta pension plan and withdrawing Alberta's pension share of the CPP out of that fund and building their own provincial pension plan. We've seen some pretty authoritative people talking about this and suggesting that the reason for this is to provide capital to this province's capital-starved oil and gas industry. So you saw Don Braden, the Calgary Herald, talking about this. You also saw former Wild Rose Alliance Party leader, Danielle Smith, who has a radio show now that maybe some of you listen to, about talking about how an Alberta pension plan would be a way to bring capital to the oil and gas sector and be a hedge against the divestment moves of pension funds across Canada internationally. I'll also just note that AIMCo's board itself has some ties to the oil and gas industry. J. Richard Bird, who was on the board until 2020. He was a longtime executive at Enbridge and currently serves on the board of 3 different Enbridge subsidiaries. Another director of AIMCo sat on the boards of 5 different fossil fuel companies. And we're seeing the political neutrality of AIMCo being brought into question, not just by the left, but also by the right. So in recent years, AIMCo's independence has been called into question. In 2017, the Alberta Progressive Conservatives and Wild Rose Alliance accused the governing NDP of changing regulations guiding the appointment of AIMCo board members and called on the province's Auditor General to investigate. Last fall, you probably heard of Alberta Bill 22, which is designed to strengthen government control and weaken the influence of the unions whose members fund the plans and sit on the board. So it really looks like political parties in Alberta are starting to use AIMCo as a potential source of funding for the province's oil and gas sector, with large implications for the beneficiaries of that plan. And I would just note that it's totally inappropriate for a pension fund to be doing that. AIMCo's mandate is to maximize returns for beneficiaries, not to invest in Alberta's economic development. If you want to contrast that with, for example, a pension fund that does have that mandate, the Quebec pension plan, for example, explicitly has in legislation that is supposed to invest in Quebec's economic development. AIMCo does not have that mandate. You could argue whether it should or not, but for a pension plan to be opining on controversial oil and gas issues and the government directing funds into its pet projects, it's problematic and suggests that there might be a problem with AIMCo's governance and its ability to control this political influence. Just moving along to the slide about divestment. Like all Canadian pension funds, there's no screen for investments in fossil fuels at AIMCo. Like I said, it prefers engagement over divestment, so it wants to own these oil companies and persuade their executives to slowly reduce carbon emissions instead of pulling their funds and financing directly. We find this a little bit of a double standard because it does have screens in several other areas of the economy, including tobacco, nuclear weapons, cluster munitions, and other weapons manufacturers. So AIMCo is saying that they are going to restrict investment in these sectors because of international treaties signed by Canada. But we don't understand why they don't apply the same standard to climate change, because Canada is a signatory to the Paris Agreement, of course. Moving on, I just wanted to note that, like, I know this is a new conversation in Canada, but the divestment of pension funds and other asset managers is going mainstream globally, and not just for moral reasons related to climate change, but for financial reasons. Every week, it seems like there's a new announcement from banks, asset managers, insurance companies, sovereign wealth funds, cities, and other pension funds that are blacklisting fossil fuels and pulling their financing out of oil, gas, and coal. Usually they start with coal, oil sands, and Arctic oil and gas, because those with the highest reputational damage and also with the highest emissions. And we've already seen $15 trillion globally that have been at least partially excluded from financing fossil fuels, including 162 other pension funds. So the reality is that these fossil-free portfolios are actually showing better financial returns. A recent survey of portfolio managers that did divest report that their returns have either been neutrally affected by fossil fuel divestment or have had actual positive effects on their investments. So Canada's pension funds and AIMCo in particular are actually at risk of falling behind on this global trend away from investing in fossil fuels. We can talk more about AIMCo's investments in the Q&A, but I just want to kind of talk a little bit about what Shift does and how we can help with this issue. So for one, we have prepared some climate risk toolkits. We have one for AIMCo. It essentially goes over in much more detail what I went over in this presentation about how it manages climate risk, how it approaches companies it owns, its divestment policies, its investments in climate solutions and fossil fuels. I'm happy to share that with this group after this presentation in a follow-up email. We deliver workshops to groups just like yours, to union locals, to environmental groups, to groups of pension savers and beneficiaries, to pension funds themselves sometimes. So we'd be happy to deliver this presentation to other networks that you might have. We have an online action tool. You can go to shiftyourpension.ca, or that link that I have up there right now, that allows you to send a letter to AIMCo or another pension fund, including CPP. With just 2 clicks, you can send a letter calling them to increase their investments in climate solutions. We've arranged meetings between beneficiaries and fund managers so they can actually have a face-to-face about their concerns. We mobilize beneficiaries to attend annual general meetings and ask them really pressing questions about climate change. And we've also been doing some increasing media work. If you want to go to the next page, Adam. For example, in January, we called out AIMCo for making a risky investment in Coastal GasLink. We've been doing a lot of work to pressure the Canada Pension Plan recently. And we've also been working with a lot of funds here in Ontario, the Ontario Teachers Pension Plan and OMERS in particular. So we've really been trying to force this issue onto the media agenda, and we think it's working. We're finding that these funds are quite sensitive to negative media attention. A few of you might remember a couple of years ago when it came out that the Canada Pension Plan was invested in private prison companies that were detaining migrant children along the Mexico-US border. This became a huge fiasco for them. They're very sensitive to this kind of negative press. And within a week, the Canada Pension Plan divested of those 2 private prison companies. So we actually do think that shining a light on these investments helps move the dial in the right direction. I'm going to end it off there. It's about 4 o'clock. I just want to draw your attention to our online action tool again, if you want to go to shiftyourpension.ca. And this last slide here, I like to show it because obviously we're all trying to reduce our emissions and do our parts to stave off the climate crisis. And obviously making personal changes is a good thing, including stuff like, getting an electric vehicle or becoming a vegetarian or eating less meat, or maybe taking a few less flights per year. Those are all tangible things that reduce emissions, but we just wanted to show that shifting investments, particularly huge pools of capital, like a pension fund away from fossil fuels, actually has a much bigger impact on reducing emissions. So that's kind of the theory behind the work that we do, is to get these massive multi-hundred billion pools of capital to start putting that financing into climate solutions, so that we're not locking in carbon for decades to come. I'll end it off there. Maybe Adam can report back on the polls, and then we can get into some Q&A.
Great. Yeah. So the first poll response didn't say it, but I saw that it was a bit of a mixed response, actually. I think there was sort of a spectrum. People sort of agreed. Some people agreed and some people did not agree with the first poll question. That they thought that the pension fund should shift investments. So yeah, it's interesting. There's definitely a diversity of opinion on the call, which is good. And the second survey showed there are folks from the local authorities pension plan, the public service pension plan, the Alberta Teachers Retirement Fund, and the university's academic fund on the call, as well as several who selected other, who may not be a member of AIMCo. But yeah, lots of AIMCo members on the call. But also worth noting to everybody on the call, you're also all members of the Canada Pension Plan as well. So you're automatically enrolled in that as well and have influence there. So that's why don't we wrap it up there in terms of the sort of content of presenting, and take some questions. I saw there were a few questions posted. I think we may have covered off some of the answers just in our presentation there. But were there any other burning questions anyone wanted to ask?
Yeah, feel free to ask by voice if you want to unmute yourself, or just type a question into the chat and we can get to them.
And if we don't get any more, I'll go into those questions that we got.
Can I ask, please? I'm Jillian Hill. Can you hear me?
Yep, we can hear you.
I'm an LAPP pension recipient. I'm extremely distressed about the AIMCo situation. I'm very surprised that people who I know who are also pension holders or so many don't understand this or don't know anything about this. It's really something that happened in the legislature it didn't happen in the legislature actually. It just happened on the side, consulted. And most people I talk to who are LAPP or in one of the AIMCo pension funds don't know about this or don't realize it's their pension capital that's being used to fund these things. And it really bothers me. Now Jason Kenney wants our federal CPP. I'm not quite there to receive it yet, but I don't know how quickly he can make that happen. I don't know if you have any information about how long that process would take, because I'm seriously considering taking it early so I receive it, so I get it as CPP and it not transfer to Alberta. But is that true? If I am a recipient of CPP and the government of Alberta takes that over for Albertans, would we be grandfathered in to remain with the federal program rather than shift to the Alberta? Do you know? Because I am scared beyond belief about my future finances due to this activity.
Yeah, I think the short answer there is it does seem to be a political decision that's being made, and it's largely outside of the control of the pension funds themselves. It's a provincial political question. So it's one where your engagement through your union and through your MLA is probably really critical in speaking up. That's all I can really offer in terms of support, except to say that highlighting some of what we've shown in the presentation here around the financial performance is a pretty strong argument for folks to ask questions about this. I think the LAP pension fund has raised some of them publicly, but there's been a lot going on, and it's kind of hard to get a voice up above that sort of noise. So that's my suggestion. Patrick, you've thought about this a lot. Do you have any other?
Yeah, I mean, what I find particularly distressing about Bill 22 and the move to bring the Alberta Teachers Retirement Fund under AIMCo is that teachers weren't consulted. The people who pay into the fund weren't consulted at all. And they're not given any choice to switch investment managers if they find that AIMCo is not performing well. And that's the same with all the other pension plans. So usually if I'm a personal investor and my portfolio is not doing well, I have the choice of firing my investment manager and going somewhere else. And what Bill 22 does is prevents that choice from happening. So I really do think it does require policy change and political leadership to prevent this. And not being from Alberta, I wish I could be more of help, but I do think it is something that's controversial, and I do think the government's gotten a lot of blowback for it. But I share your concern with the moves that have been made by this government and what the implications might be for pensions.
Yeah, so I'll take one of the, Jim asked a question in the chat, which I think I'll raise, which he wanted us to talk a little bit about the ESG investing and sort of what that sort of frame. So there's been a very rapid and global shift over to environmental, social governance filtered investing is sort of the best way to describe it. So investors are now saying we're integrating ESG concerns into our investment strategy. And it's sort of sweeping the globe as almost as a fad, I would say. And it's positive that investors are now looking at sort of rankings and scores about the companies that they might invest in, looking at those different areas, but it's problematic from the perspective, particularly of the environment and climate change in particular, that there's no sort of clear standard or metric being applied. It's pretty Wild West. The companies themselves they provide a lot of the data themselves. So companies are out there boasting, we have great ESG scores, look at all the wonderful stuff we do, and they get ranked. But also the rankings of ESG companies is largely done within sectors. So companies that get a high ESG score will do well relative to their peers in the same sector. So, a company, as Patrick noted, a company like Suncor can get a very high ESG rating when they have catastrophically high emissions from their own operations, and a lot of pollution and a lot of liabilities questions. So, from an environmental perspective, Suncor should rank very poorly on an ESG ranking, in my opinion, but you'll see them sort of performing well. So ESG filtering isn't enough to address the climate challenge. In fact, it may serve to act as a bit of a greenwashing for investment that shouldn't be receiving capital. And so, there are other trends out there that are promising, and that's sort of what Patrick was alluding to in his sort of review of other large institutional investors around the world that have put on clear screens. Which a screen is an active rule saying we will not invest in that area specifically. So if you're going to screen for fossil fuels, some funds will say we're going to be carbon free. So you can actually, if you're asking your personal advisor, you can say I only want to invest in carbon free investments. Please screen out all high carbon assets based on this specific definition. That's taking off, and as well, we're also seeing a trend towards what you might call thematic investing. So some investors are actually saying, we're not just going to invest in things that aren't bad, don't rank poorly in an ESG screen, but we're going to actively pick companies that we think are contributing to the solution. And in the case of climate change, the solutions are, investing in clean energy, energy efficiency, clean transportation, clean agriculture. There's a whole sort of wide variety of companies that are actively part of the solution. So you can actually choose to invest in only buckets of companies in that category. So you can, if you're looking into alternatives to the sort of ESG frame, that's important. So I hope that addressed some of what you're asking about, Jim, but it's at present, the Canadian pension funds are, when we ask them about climate, they say, yes, we integrate ESG concerns into our investments. We engage the companies we work with. And that's just completely unacceptable in terms of what needs to be done here.
Thank you, Adam. That helps.
moving on to another question from Janet, just would like us to speak about CPP briefly. Patrick, did you want to talk a little bit about CPP very briefly, and we'll...
Yeah, we could talk about CPP. We've been working on them a lot lately because they just went through 2 weeks of legislatively mandated public meetings that they're required to hold every 2 years. So you might have seen a lot of talk about climate and CPP investments in the media in the last couple of weeks. And we share the same concerns about CPP as we do with the Alberta pension plan. While they're not quite as heavily exposed to fossil fuels, Alberta fossil fuels in particular, they do have some really risky investments in oil, gas, and coal. You might have seen that they have about $140 million invested in Chinese coal. They own fracking companies in Colorado that are well known for causing health problems, that are pouring money into state elections. They're heavily invested in the largest pipeline, oil sands, coal companies in the world. And like AIMCo, they don't have any kind of screen or exclusionary policy for fossil fuels. So we see the same problem with them as we do with AIMCo. And we're concerned about that. And we're also trying to mobilize Canadians to speak out about that. And we would encourage you to, if you're not a member of an AIMCo managed pension fund, to also send a letter to CPP Investments as a contributor. We're, as Canadians, as workers and retirees, we are bound to invest in this fund, and we don't seem to have much of a say in what it's invested in. So I'd encourage you to talk to CPP as well. I don't know if Adam wants to add anything to that.
Yeah, just to say,
more detailed question.
Yeah, just to say that Canada Pension Plan is the 8th largest fund of any kind on the planet. It's one of the world's largest institutional investors. So its decision making, its ability to have additional criteria to do with climate is important. I think I need to underscore this. Written right into the Paris Agreement is the need to shift financial flows away from high carbon to zero carbon. It's actually part of that strategy. It is not going to be possible to meet anything close to our goals in terms of addressing the climate crisis if we don't shift capital. And as it stands today, Canada Pension Plan has no sort of clear, and none of these pension plans do, but they don't have any clear high level commitments. So they're doing all this process work. We're integrating ESG, we're doing scenario analysis, we're doing all the sort of behind the scenes sort of understanding their climate risk behind the scenes work, but no strategy, no plan. We need pension plans to come out and say, we're going to align our investment strategy with the goals of the Paris Agreement. We're going to set a zero emissions target for the fund. We're going to set a clear action plan so that all of our staff, when they're making decisions, can make decisions right in front of them. Some people bring in new investments to the fund every week, every month, and say, what about this for an investment? And if they don't have a clear strategy down from the board level on climate change, then we're not going to get the result we need, and we're going to be exposed to these risks. So that's it's really important to reach out and tell them that, and to ask them tough questions about how they're operating. Another question from Maureen, quick one. Are there benchmarks that pension plans such as AIMCo must meet as far as return on investment? You probably saw me trying to quickly Google that. I'm looking in the annual reports of the different pension funds. They will sometimes mention what their own internal benchmark is. They don't always make it public. They do have one. And usually the benchmark is roughly based on a very conservative estimate of what the whole economy is going to do in terms of growth. So they sort of say, okay, our benchmark is a 5% return this year based on a forecast for what the whole economy will do. In a year like this, where we've had COVID-19 and the global economies faced a huge headwind, all of the benchmarks will actually likely be negative, if that makes sense. They're benchmarked against the real economy, and they usually like to beat the benchmark by a couple of percentage points. So this year, AIMCo might actually say we beat the benchmark, but they still might have actually been down year to year, if that makes sense. But if you look into the annual reports, I don't have that number in front of me, what their specific benchmark for the year is. I wouldn't be able to say, but they updated that every year. And you'll find it in last year's annual report.
There's another question from Barb asking, I guess it's more of a comment, but when Jason Kenney says, well, we do have a majority and directs AIMCo through legislation, how can we in fact influence? We talked a little bit about that before. I don't know if there's anything you'd like to add, Adam.
Yeah, I mean, in terms of what Shift can provide as advice, I think it's a political question that's a tough one for folks in Alberta on the ground to grapple with. I don't know if we're going to be able to provide any helpful information on how to address that, except to say that, if you're a member of the different sub plans, you have labor representation that is aware of this and is working on it, and sending them a note that you care and that they should be actively working on it would be useful. And this is a bit of a long game as well. The decisions of individual governments come and go, but sort of these plans will still be there. So engaging through your own labor representatives, so your own employer, can matter because they actually get to appoint oversight on the board usually. So they actually have some say in the governance. That's all I can suggest. And I know that's not particularly satisfying. Were there other questions that came up?
Yeah, I've actually gotten a couple. They were sent to me privately. I'm not sure if maybe folks meant to send to everyone, but I think they're fine to share. There's a question about the eco elders have had some experience with op-ed pieces. I see this AIMCo issue, particularly already the governance and perhaps other mandate behavior as ripe for this. Have you had successful experience with op-eds in other jurisdictions? Any advice for us on this?
Yeah, op-eds are great, really effective tool. That they can be challenging to get placed into newspapers. So there's sort of some clear rules about how to do that well, but mainly the rules are make sure it's really timely. So it's linked to an active news story, something that was actually in the paper recently. Make sure it's the right length and make sure, all the sort of good op-ed best practices there. But overall, we think they're quite effective because they draw attention to the issue directly. I would also suggest including the actual names of people you want to pay attention to the op-ed in the op-ed. People Google themselves. They have Google alerts. They pay attention to when they're specifically mentioned, and that can be useful. So if you're talking about pension managers, using their names and calling them out brings them into the conversation. I would also, at Shift, we're really strong advocates for asking difficult questions. You can ask a comment and they'll say, great, thanks for the comment, and it kind of dies, and that's the end of the conversation. But if you actually ask smart, constructive questions, it's incumbent on the pension funds to actually respond to you. And that's what our letter tool does. If you go on to our website, shiftyourpension.ca, and enter in your name, it'll send a letter, but included in that letter are some questions, and we actually expect the pension fund to write you back. And that's how we sort of move things forward. So you can do that as well in an op-ed format, saying, what's the plan here? What's going on? If they claim to be responsible investment managers, what's the strategy? We don't see it.
Yeah, and just on the op-ed piece, I think it's a great idea as well, especially with Bill 22 and the potential Alberta pension plan, and the ongoing controversy about oil and gas being such a live media topic. I think that it is definitely something that the Calgary Herald or the Edmonton Journal would be interested in publishing, and we'd be happy to help craft or advise an op-ed for you. I think it's a lot more powerful if it comes from folks like you, Albertans who live in Calgary, than an NGO in Toronto, but we'd be happy to advise on that and support this group in drafting something and giving some tips to send it in. And just on that note as well, I mentioned before that we have a pension engagement toolkit for AIMCo. And like I said, we'll definitely share that with this group in a follow-up email through the Eco Elders, so you can do a bit more of a deep dive into AIMCo with that, because it's quite long and dense if you're into it.
Yeah. I got a couple other questions that came through privately, probably inadvertently, which I'll ask as well. Maureen was asking about the tremendous losses that some Calgarians have faced from that hailstorm that in Northeast Calgary. Is there any link to climate change? And I think, just I can sort of say the standard reply there, which is each individual weather event, you might not say that it occurred because of climate change, but scientists would strongly agree that climate is enhancing weather. So if you have an extreme, if you have a hailstorm in previous years, we would have gotten bad hailstorms, but as climate change continues, the number of hailstorms that reach that extreme threshold where they cause substantial difficult property damage has increased. So it's pretty safe to say that these are sort of climate boosted weather events. And we're well past the point where that's debatable anymore. Yeah, and I did get another question here from Jim as well on alternatives to plastic. I know that's sort of part of the conversation here about the future, and part of the sort of conversation around the future demand for oil in particular. You were asking about how can you replace plastics sort of in, and I think the answer is there are actually a lot of plastic alternatives. A lot of plastic that we use in society is not actually required to be single-use disposable. There's a lot of examples there of using biodegradable materials or other things, but the key point as it fits into this conversation around plastic is that the oil industry is now, they have to tell a story that is credible, that would entice investors to want to keep putting capital into their businesses. So that's investors or lenders. And the oil industry for years has sort of relied on this, Asia is growing really quickly, so countries like China are going to keep demanding more oil forever. Therefore, our business model is sound. Please invest in us. Please give us a loan. That's not looking particularly strong anymore. And as we're seeing the rapid electrification of vehicles around the world, we're going to expect oil demand to drop. So in recent years, we've seen the oil and gas industry leaning very heavily in their story on petrochemicals, saying, well, we think demand for plastics may double in coming years, and that's going to pick up the slack that we're seeing lost in other areas. That's not credible in any way, and I've followed that quite closely in the International Energy Agency reports and a number of other places. Petrochemical uses of oil are a tiny percentage, less than 10%, depending on which things you include in there. Vast majority of oil and gas globally is combusted. So even if you were to double the amount of petrochemicals, it wouldn't materially make up the loss that's coming for the oil and gas industry. But doubling plastic is completely off the table. In fact, there's a global crisis around plastic that's causing environmental damage all over the planet, and ecosystem collapse. And a number of countries are moving quickly towards, not quickly enough, but quickly towards banning single-use plastics and addressing the crisis. So we actually expect plastic demand to go down along with combustion uses of oil. So that's just part of that story that industry is trying to tell us to sort of keep the taps open, and they're getting increasingly desperate. So you're going to really see quite a few interesting, questionable things out of the mouths of fossil fuel executives trying to keep a credible narrative around their future demand prospects. And right now, another one you're hearing a lot in Alberta is the potential for hydrogen, using gas that exists in Alberta, converting it into blue hydrogen. And there's not a lot of credibility to the economics of doing that. So I could go on and on about that, but just to sort of keep your cynicism levels high when you hear questions about sort of things that will drive future oil and gas demand into the future forever.
Good to know. Thanks, Adam.
There's a quick question from Barb here. Just can you remind us how many quarters AIMCo has underperformed the industry? Just to clarify, I mentioned during the presentation that was the local authorities pension plan that had underperformed its benchmarks through AIMCo investments for 46 consecutive quarters, so almost 12 years.
Yeah.
And I just wanted to pick up as well on the question about the hailstorm and the broader issue of insurance companies. We showed that graph before of the growing damage and costs in the billions of dollars to Canadians. Those were just insurance costs. So it's not even including all of the private costs of these increasing climate damages we've seen. And there's a really interesting front kind of opening up in the finance world where groups like ours are starting to target insurance companies. So insurance companies are, there's the potential for them to go bankrupt because they can't afford to pay out premiums for all this climate damage. We're starting to see them not covering people who might have a home in a flood risk area or in a wildfire risk area. So they're live to these climate concerns. But on the other hand, they continue to provide insurance policies to fossil fuel infrastructure. So what we're seeing groups starting to do now is pressure insurance companies to withhold coverage to pipelines or export terminals or oil sands mines kind of thing, on the basis that it's inconsistent with their business model to continue insuring companies that are causing all this damage. So keep your eyes out for groups like that that are starting to get active in Canada, looking at insurance companies.
Yep. One last little question I must have sparked from Janet on the blue hydrogen piece. And she's asking, I understand blue hydrogen does not burn the carbon. Is that not the case? So just a quick review of hydrogen. I'm sorry, this is a bit of a divergence, but it's relevant to this sort of wider, should I invest financial risk piece. Alberta's betting the farm on hydrogen. They're talking a lot about, so there's roughly three kinds of hydrogen we're talking about. One is sort of brown gray hydrogen, which implies it comes from a dirty source. So you can take natural gas, you can crack it, it emits a substantial amount of CO2, and what's left is the hydrogen molecule, and you can put that in a pipe and you can use it. That's very high carbon. Blue hydrogen is when you do that and you take the CO2 and then you resequester that somehow. You bury it in the ground or find a way of capturing the CO2 so it doesn't end up in the atmosphere. And green hydrogen is where you can actually just use renewable energy to just directly crack water into hydrogen and oxygen, and it produces no CO2. So green hydrogen is the solution. It's quite useful in terms of climate change. It's expensive right now, but it has some uses. So there will absolutely be a real demand for green hydrogen in the future as part of this. How do we replace our energy sources? Blue hydrogen sounds great, but in fact, the carbon capture part of that is questionable. There's not a lot of evidence that that's commercially viable. It's very expensive to capture the capture the carbon dioxide that comes out of that process. And everything's in a pilot stage, and it's actually a lot more expensive to produce hydrogen and capture than it is to just use the dirty hydrogen that just is basically cracking gas. So right now, the whole hydrogen industry is just cracking gas and dumping most of the CO2 in the air. And that's the likely trajectory. So right now we're seeing Alberta say, we're going to move forward with blue hydrogen. Well, there's no business case for that to happen without massive public subsidies. It's not going to be viable on its own. So I would be very skeptical about claims that blue hydrogen is going to save the world. There's carbon capture and storage is not panned out as a scalable, commercially viable activity by and large at the moment. And that's a long-winded answer to hydrogen, and I'm sorry. Any last questions before we move to wrap up? It's been a really good set of questions here. And seeing none, I will take the opportunity to thank all of you for inviting us to come speak and for a really great conversation today. We really would love it if you could all please go and take the action tool on our website as a starting point. You'll get responses, and it's a great way to sort of get going on this. If you want to work with us further, if you get a response from the pension fund, please email us. Patrick and I can help you with another follow-up response to the pension fund for maybe getting a meeting or speaking at an AGM. There's more you can do after you've taken the initial action. So we really want to thank you for all of your efforts to learn more about this and to participate and take action. It really has a huge impact. Patrick, do you want to say anything on closing?
Yeah, I just wanted to say thank you as well. And like Adam said, we're happy to help with following up with your pension fund, with crafting an op-ed. If there's other retiree groups or community groups that you want us to give a presentation to, we're happy to do another workshop. We want to, expand the reach of this campaign. And yeah, I just wanted to thank the folks at Eco Elders for Climate Action and Calgary Climate Hub for inviting us. It's great for us to get to talk to Albertans as well from downtown Toronto. I have family from Grand Prairie. My uncle works for Cenovus, and my cousin is a engineer for a fracking company. So this issue really, touches on me personally, and I really am concerned about Alberta's future and want to do what we can to help with this transition to a different energy future. So thanks for having us today.
Well, I want to say thanks to both you, Patrick, and Adam. We're somewhat concerned about Alberta as well. And it was a very useful presentation and very effective, I think. And I'm sure that we can maybe use some help from you in terms of maybe preparing op-eds or where else we go with this. This is like a start. Yeah. And we'd love to collaborate with you further on these sorts of issues.
Great.
Yeah, thank you very much.
It's the start of a conversation, and we'll be here to help as we go forward. So great to talk to all of you, and best of luck, and hopefully we'll be in touch soon.
Okay. Thank you.
Yes. Thanks, everyone.
Thanks, Simon. Thanks, Patrick.
That was great. Good job.